Hello, and welcome to our webcast. I'm Amy Pendergrass with Moss Adams, and I'm going to get us started for today's session, The Future of Banking and How to Find Your Competitive Edge. Before we begin, I'm going to play a brief video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Hello, everyone.
All right.
Thank you for today.
And now I'd like to introduce today's moderator, Gabe Nishon, Partner and Financial Institutions National Practice Leader. Gabe, I will turn it over to you.
All right, jumping the gun already. Hello, everyone. I'm Gabe Nishon, National Practice Leader here at Moss Adams, and I'm very pleased to introduce our topic and our speaker today, Future of Banking and How to Find Your Competitive Edge. I think it's very timely, as many of you know. A lot of us get the alerts, and the FDIC tech updates are increasing with frequency. For sure, last week, I think many of us noticed the Fed paper on partnering with fintechs, and it very much focused on a culture of innovation. And that's very timely as well. The digital assets paper, I think we're all waiting eagerly for, hopefully this month or shortly thereafter, is out there as well. We've got, I noticed in the AICPA banking conference next week, our presenter is also on a panel there. And so probably getting a little preview of his content there too. So very excited about the topic and very excited about our speaker, Sultan Meghji, Chief Innovation Officer at the FDIC. When I got the notice via email that the FDIC had hired a Chief Innovation Officer, I was like, that sounds fantastic. That's great. And then I noticed it was Sultan, and I was like, we presented together last year. It was very well received on the future of banking and banking technology and stuff. And so that was my second thought. My second thought was, with his background, he's going to be fantastic at this. And then my third thought was, we got to get him as part of our webcast series and see what we can do. So very much appreciate Sultan being here. And I know he likes to get to it, and you can see a lot of his past there. I would reference Yelena McWilliams, FDIC chair. She's affectionately, and I say very affectionately, referred to Sultan as her unicorn. And you look at his background in cyber and AI, and she didn't want a regulator, didn't want a Washington insider, didn't want a lawyer, but wanted that business acumen and experience and the entrepreneurial spirit and the fintech side with the core processing. And then what really probably puts the tip on the unicorn is that having worked with the digital banking and really the inclusion concept, doing some banking work in Africa and stuff. So super excited to have Sultan here presenting. And as I get ready to hand it over to him, we've got a polling question that we're going to start with to help frame things out. And I would say, please submit your questions. I'm going to go in the background and just comb through the questions and try to frame them up as well. And it will be a lot more helpful to have questions as we go versus all at the end, and we were only able to get to 2 of them. So I'll kick it back to Amy.
All right, so I'm going to start us with our first polling question here, and it is, what are you most interested in hearing about today? And your options are the origins and aspirations of FDI tech, B, anything about neobanks, C, rapid phase prototyping versus the Sprint program, D, non-fungible tokens, or E, impact of innovation on the regulatory oversight process. And we will give you a few moments to respond. To respond, please click the button next to the answer you choose and hit submit. And if you're having trouble seeing the submit button, you will need to enlarge the slide area. And it looks like most are responding. We'll leave it up for another 5 seconds or so. Okay, here are the results.
Sultan, we'll leave it to you to take it away.
Fantastic. Well, thank you, Gabe, and the Moss Adams team for inviting me again to speak this year. I remember fondly speaking last year when I had a completely different hat on, and that was a heck of a fun conversation. Gabe and I were visiting earlier about the quality of the questions, and so I will just reiterate what Gabe said. I'd love to get your questions as we go into this conversation. So please do submit them and keep Gabe busy in the background while we're working on this. Second thing is, here's that one first initial difference between this conversation this year and the one last year is I have to start off with the dreaded regulatory disclaimer that I'm sure many of you have heard from a variety of regulators in the past. And the refrain goes something like this. These are my views alone and not the views of the FDIC, the U.S. government, the chairman of the FDIC, the president of the United States, or the chairman's dogs. And so these are only my views. And so please take them what they are. This is not regulatory guidance or should supersede in any way anything you deal with in your normal regulatory environment. Now with the boring stuff out of the way, the third thing I'd like to say is looking at this poll response, I have to say I'm incredibly happy to see non-fungible tokens be next to last. That is a fun, exciting area, but it's one that gets dangerously close to things I'm not going to be talking about today. But it is exciting to talk about the impact of innovation on the regulatory system, and there's a lot of really fun and exciting stuff there. Here let me just jump through the disclaimer view there so you see that all officially. And so let's jump in and talk about why FDI tech, which really gets to the heart of that question. What does innovation mean to the regulatory system? It's a fascinating discussion because I'm sure many of you in dealing with the regulatory community over the last few decades have struggled with either the pace of interacting with them. Regulators are not notoriously quick in many ways. In many cases, it's really opaque. You don't really know what's going on, and then all of a sudden, boom, something comes out, and then you have to immediately respond to it. So there's a degree of transparency that it would be good to put in the system. And then third, there is this kind of reactive nature of the regulators. When I first joined, and I was talking to a bunch of our examination staff, they were talking about how frustrating and stressful it is for them, where they go in, they're doing an examination, and they all of a sudden, oh, we hear about this fintech, or oh, we hear about this other thing, and it's kind of out of the blue. And they have no idea how to navigate it or how to even respond to it. So they have to go off and find experts, and then the regulators run their process. And then they come back, and months have gone by, and it's a real challenge. And so we created FDI Tech which is what we canonically call the tech lab at FDIC, is a horizontal function. It spans across the entire organization. And it's really focused on 4 key things. The first is to engage the entire ecosystem, the entire community, whether it's people like you who are running institutions, or vendors and service providers, to other regulators, to states, to our friends in the NCUA and the credit union community. We want to engage because we see an amazing future for banks in the United States and credit unions, but we want to make sure we get there. And I'll come back to that and talk about it. But first, we want to engage. And so I spend a lot of my time listening. We're doing office hours, which I'll talk about later. We do all these other things just so that we can hear more from people like you. And so my first plug is we created an email inbox, went through all the complicated legal steps and statutory and regulatory steps. So there is an open email box, and you can just send an email into it. And a member of my staff looks at every single email that goes in there, and it is innovation@fdic.gov. You'll hear about it later. It comes up later. But if you ever want to engage with us and you're just really not sure, you just have a question, or you just want to spend 5 minutes chatting with an expert about something, just email innovation@fdic.gov, and we'll figure out the right way to get you connected to the right person. The second thing is, once we listen, we start acting. And we talk about conducting ourselves, and it's moving into action. And so, the U.S. government, again, is not notoriously quick in some ways of getting things done. And I'm trying to bring a little bit of that private sector energy from, running startups and being in corporate America into an opportunity where we can actually start doing things. And so I'm just a little over 6 months in the job. We've done the RFIs, we've done a bunch of these other things, but now we're doing tech sprints. Now we're doing the next phase of rapid phase prototyping. And it's all about action. It's all about driving that value. Pretty much everybody listening to the sound of my voice is accountable to shareholders who, don't want to wait 3 years for value to be created or for something to happen. And I don't think, the regulatory community should be that way too. And so I'm trying to institute a pace of execution in the organization closer to what you guys would be comfortable, what you guys see in the private sector. Third, the amount of new technology coming into this system is just incredible. And it's everything from just new basic systems like systems of record for your transactional data, like a core, all the way through to artificial intelligence and quantum computing and space-based banking, which I used to joke was a joke, and now it's a real thing. But we have to support. We have to support ourselves, make sure the FDIC is able to handle it, make sure our regulatory partners and other government agencies are there, but also make sure the ecosystem is there and get in front of these activities. And then finally, we need to expand banking services to everyone. Not every American adult has a bank account. Not every American adult has a full credit report. Not every American has access to the right banking products and services that are fit for them at the touch of their fingerprints. And that's a gap for us. It's a gap for us as a nation. It's a gap for us as a species. But in my view, it is something that is a huge limiter to our economic power. So all of these are very simple, basic views as to why we created the Tech Lab. And the innovation function at FDIC actually predates the Tech Lab creation by almost 2 years. The Chairman McWilliams spent a lot of time getting some of these pieces moving. And then they really spent a lot of energy trying to get somebody in this job. And it was really just a kind of a lucky coincidence that I get to sit in this job for the first time, for the first person to sit in this job. But the most interesting part about it to me is how it was framed. It was not framed as photocopy FCA's innovation function. FCA is the Financial Conduct Authority in England. It wasn't, duplicate what some other agency did. It wasn't, hey, let's put out some press releases and then go take a 90-minute lunch or anything like that. Her demand, and it was an actual demand, and I hear it as a regular refrain, is we have to start moving the needle in this area. We need to start figuring out how to close this gap between where we need to be and where we are. And so we started putting a tremendous amount of thought into what that actually meant. So one of the things that isn't on here, it wasn't on the bio, but if you look me up on LinkedIn or something, you'll see that I'm a member of Bretton Woods. And for those who are history buffs, you'll remember Bretton Woods at the end of World War II was a series of meetings basically that helped establish the global financial order that really governed from 1945 until today. And it helped establish things like the Marshall Plan, the World Trade Organization, the World Bank, the IMF. And it was a fundamental piece of American leadership. It was saying, listen, the world's economy is in crisis. We need to set it on the right course, and we need to guide it in a way that is pro-capitalist, pro-democracy, pro-open markets. And so they did. And look at what came of that. Look at the 20th century. Look at how our economy and how the world order was shaped around those amazingly positive American ideals. And so one of the things that I really focused on as I was coming into this job was to say, okay, if from 1945 to 2021, call that, step one. Step two is from 2021 to 2050. Okay, let's just look at the next, 29 years. What do we have to do to continue to have the American banking system be the backbone of our species on this planet? How can we make sure that we embrace democracy, that we embrace open free market capitals, and we keep the world aimed in that direction? Because, as I'm sure many people here know, the notion of a great power conversation is now back in the press. I'm a child of the Cold War, so this is like listening to the oldie or classic station on the radio in my car. But for us, we are thinking strategically. I want the United States to be number one and to continue to be number one. I'm really fortunate that half of my family came over like the third ship after the Mayflower, and the other half of my family came over basically as refugees in the 70s. And that gives me, I think, a great perspective to say, listen, we are the greatest nation in the world, and we need to make sure we continue to be that way. And being able to move the needle on that and to be able to say, yes, and this is how we keep that aimed in the right direction is one of the reasons I took this job. But it does frame why the Tech Lab exists and why it's a little different than what you see in other agencies and other organizations. We are not here to do some whiz-bang technology. We are not here for press releases. We are here to fundamentally ensure that we are aimed in the right direction as a nation in this way. So with that framing, and you understand the why we exist the way we do, let me scope the conversation a little bit, because this is a huge conversation. And it gets back to the question in the poll, why innovation and what does it matter? So those of you who are old enough to remember, you Google this if you don't, look up the history of the call report. It is an absolutely fascinating piece of history. Back in the 50s, comptroller of the currency would call a bank and you just start asking questions, how many accounts, what's your debt, what's your 90-day delinquency, what's your balance sheet, da-da-da-da-da. And we all are dealing with a subtly digitized version of that discussion here, 60, 70 years later. And one of the biggest and most important things to remember is that the objective of the regulatory system is very straightforward. You go back to the FDIC Act, you look at why we exist as an agency. It's to ensure the safety and soundness of the financial system. That's the quote out of the statutory authority. And for us, it's very simple. What it is. The objective is very clear. The how we get there, that's where innovation comes in, because the amount of data is skyrocketing. Everything is based on data, and it's all got to be in a computer one way or another. And so the question is, if you used to scan a paper file and then email that digital file or move it over, and then somehow it ends up in one of our computer systems, and then one of our people reads it, and then they copy and paste or type in a few numbers, and then eventually 90 days, 120 days later, it ends up in a report that somebody like our chairman sees. Given real-time payments, given credit cards, given all the different moving pieces, we've got to take those timelines and compress them. We also have to remove errors from the system. We also have to look for bad behavior in the system. And all of these things are things that can't really wait for months, which is what it has been. And so I'll talk about it a little bit later, but if you think about it, it's about removing friction from the system, removing errors from the system, and really working in two areas. One is managing the risks, both current and new, but also finding ways to highlight and make better use of the opportunities that are available to us. And then at the end of the day, for those who know a little bit about me, I've done the CEO thing a couple of times, been in corporate America a bunch. And one of the things that I've kind of been notorious for in certain circles is wielding a machete to hit the bottom line a little bit. And so I always have that eye to this too, because we're a big federal agency, and we should be as efficient as possible. So there's the framing. That's the framing of it. Now I believe it is time for us to pop over to another polling question.
All right, thank you. So the second polling question is, what factors are contributing to change across the banking system? A, adoption of new technologies. B, addition of new players. C, growth of financial products and services. Or D, all of the above. And as a reminder, if you would like to receive CPE for today's webcast, you will need to respond to at least 3 of the 4 polling questions that we pull up throughout the webcast. All right, and here are the results.
I guess I shouldn't be surprised to see D, all of the above. All right, so this is fascinating to see you guys say that. I wish I could do a follow-on, which is to say, what you think the breakdown of those is. But it is kind of interesting to me because an interesting feature is I'm probably one of the few people in the world who's driven new tech and new products through 3 different regulatory systems here in the U.S. I've done it on the equity side. I've done it with the FDA on clinical diagnostics and genetics, and I did it in banking, and then obviously now sit as a regulator. One of the things that I find most fascinating about the banking system today and the changes in it is that so much of that change is being done outside of the regulatory system. Right. So, for example, when we were modernizing the New York Stock Exchange and doing things like moving from fractional to decimal, if anyone's old enough to remember that, or beginning to open it up so that people could buy or sell stocks over the internet, that was, my team was doing a lot of that work. And one of the most interesting things that happened when those programs were spun up is the SEC was in the room for those conversations. The stock exchange was in the room for those conversations, and it really made it really interesting and useful. It was kind of a top-down thing. It was sort of like, okay, we're going to do this here and we're going to drive into that. NASDAQ was in the room, et cetera. And it really allowed us to do a lot of change in a very short amount of time. I mean, we really only spent 18 months going from kind of the old system to the new system, which went online in August of 2001, a bit of history there. So it was online when September 11th happened. And obviously we were hit pretty badly when that occurred. But one of the reasons that the markets could come up 2 weeks later was because we had that new technology in place running in a couple of places. In fact, I'm still not allowed to talk about where some of those places are. But it allowed us to, besides getting a shower, a couple of points in there because I was living at the office, but then turn around and actually get the markets back up online, and then go in and assist FBI and others as we looked at, bad activity that happened in the markets in the moments leading up to it that helped us figure out, who the responsible parties were, et cetera. But that was done inside the system. If you look over the last, 5, 6, 7 years, in the banking system, so much of that, a lot of you are doing a lot of great work there, but then there's a lot of activity happening directly outside the system, either through technology providers or through just people completely operating outside of it, in some ways, like some of the distributed assets activities and crypto and stuff like that. And we're at this moment where not only is there technology, not only is there kind of some stuff in the system and some stuff outside of the system, but it creates this very fractured view. And this question, I think, is a great example of that because, there have been many new players. There are, roughly speaking, 10 times as many fintechs as there are banks in the United States. The growth of products and services has evolved tremendously. Now I can do a million things with my phone. In fact, I was I was in New York for some of the September 11th stuff this last weekend, and I was completely 100% functional for that whole weekend because I went up early. I was doing everything I do for the government through my phone. I was on secured Zooms. I was doing kind of all the stuff that I have to do my job, but I was doing it through a phone. And if I can do that with communications, it goes order of magnitude more than what you can do from a financial services perspective. And then that gets into new technologies. There are tremendous new technologies coming online. All of us have artificial intelligence doing things in our lives on a daily basis. It just might not be, it might be a little opaque to us. It might not just be, a virtual assistant on a phone. It could be how the cloud environments for our institution operate and keep themselves balanced and secured. So there's a lot there. It's always fascinating to me to see kind of how people have organized their thinking around these changes, right? Because one of the things I love about community banks and credit unions that operate in smaller communities, because they know their communities better than anybody else. And so they know the right 3 or 4 products and services that make the most sense for their customer base, either on the consumer side or the commercial side. But what's really interesting is to watch how geography no longer is as relevant as it used to be. The geography of I worked in these 3 zip codes and I knew those people, and all of a sudden a fintech or a neobank or someone like that could parachute in, and just because they bought the right ad on a social media network, all of a sudden you could see a significant percentage drop in new deposits or something like that for a month. And so that becomes that causes people to have other muscles. So there is, I would say in D, all of the above. I've also add the people side of it too, because we as an industry are really going through a pretty significant human capital change. The generational changes are quite a big deal. The baby boomers retiring, and with a Gen X workforce that's roughly half the size of the baby boomers at their height, you're seeing jobs go from a baby boomer to a millennial just because there are not enough Gen Xers in the middle. And so you're seeing, institutional knowledge go, you're seeing a completely different way of operating. I know a number of people in the federal government who only got a laptop because of COVID, right? Which is mind-blowing to me. But, they didn't need it. They had a desktop, they were in the office, they had an assistant, they had staff, they could just kind of walk around with their piles of papers, right? And then to see that person replaced by someone who tries to do everything through their phone, you can't help but see change in the system because of that workforce evolution. So I agree with all of the above. I am intrigued to see what some of the other polling is, but let me jump over so you guys understand. If I talked about the 3 structures in terms of where our scope is in terms of the other agencies and other governments versus inside FDIC versus the rest of the market to all of you, if that's the x-axis, if you will, the y-axis are these 4 pillars. And these are, we spent a bunch of time, actually before I even joined, working with the chairman to kind of reorient a little bit of the strategy of FDIC so we could figure out where to put our resources. And so there's a direct overlap between these 4 pillars and what I broadly call the enterprise strategy for how the FDIC is moving forward. But it does all anchor on data. I talked about it a bit earlier, but data is everything. And, the traditional way of taking it from analog to digital, then copying it over and moving it and all these steps, that opens up some great value, and it has, but that's what I call the 1.0 to 2.0 discussion. So 1.0 is getting it into a computer, right? And we've spent decades doing that. 2.0 is about, 2.0 is entirely about making it easily accessible. So I'm accessing it through a web page, I'm accessing it through my phone, whatever it is. And it's a little more straightforward. 3.0, which is where we're going now, is about having the technology do most of the work so that I'm not going in and doing anything. The technology is reaching out to me and telling me, hey, this bank they're up on 90-day delinquencies. They're trending in the wrong way. And we see this data for the last 3 weeks and it's continuing to trend the wrong way. You need to give that CEO a call. And so moving to a place where we're talking about 3.0 from a data perspective is a big part of this next discussion. But let me talk about these 4 pillars very briefly. The first is inclusion. I said it at the beginning, but I'll absolutely repeat it. And I'll highlight that it's not just consumer inclusion that I worry about, it's also commercial inclusion. Just a few years ago, if you were running a small business like so many people are, you could not sign up for a small business checking account online. It was almost impossible. At one point, just a few years ago, we did a survey, and I think there were 4 community banks in the United States and credit unions that could do this. And so, so much of our economic development comes from small business. Roughly speaking, half of new job creation comes from companies with less than 10 employees. That is huge. And there is an outsized percentage of women and minority ownership in those small businesses. So if you're not doing small business work digitally, you're missing out on just such a huge part of the market, and it's the fastest growing part as well. It's a huge contributor to GDP and a huge contributor to local economic activity. a few years ago, I think it was the Kauffman Foundation, put out a paper that basically said for every dollar of that you brought into your local community, you actually created $7 additional in economic activity between paying people and rent and utilities and restaurants and all that stuff. And that is the bread and butter of where you guys live. So the more, if you're operating close to what our How America Banks survey data comes out, and you're getting somewhere between somewhere less than 93% of the local population, which is kind of the top end, great. You've got, just imagine if you could increase NIM by 7%, and that's a huge win, right? And to me, inclusion is the mechanism by which we do that. We just actually on Friday at the FDIC closed our first inclusion tech sprint, and we had a big demo day and a bunch of presentations. We announced a couple of winners on Monday. That was one of the coolest things ever. Such creativity, such partnership between the tech side and the banking side. It was absolutely fantastic. If you haven't looked it up and looked at what the teams did and what we've talked about, you should absolutely do that. I will not do them justice here if I try to explain it. But for me, inclusion is really about that last mile. You have these customers in your zip codes, and for whatever reason, they haven't decided to sign up with you. Okay, what do we do about that? Is it because they're just not banked? Is it because they're underbanked? Is it because the overall environment is they're just not aimed in the right direction? Like, what's going on there? And let's really dig into that. And as we dig more and more into this, again, we're only a few months into this discussion, but there's some really great data that hopefully we'll be able to talk about more that I think leads to not just what's going on, but also why. And the why is really important as it relates to inclusion. The United States is becoming much more diverse, and I have this verbal twitch where I talk about the average American. I'm not sure there's actually an average I think we're pretty far away from that. So I think there's a lot for us to do to figure out how to make sure that all the institutions are going out there and trying to find all their customers so that we can make sure that every American can operate in the system effectively. The second one is resilience. And resilience, for a while, I almost called it just cybersecurity, but it's far more than that. Resilience, and if you really want to hear an expert talk about this, on the FDIC podcast, I take it over once a month. And 2 months ago, I interviewed a friend of mine, former Homeland Security Secretary Michael Chertoff, and he talks about it. And what he says is, listen, resilience is straightforward. It's taking a punch. And not just taking a punch, but knowing that you're going to take a punch. And having yourself punched so that you can practice recovering from the punch. I love the punch metaphor. He has another one about the immune system, but that's a little more technical. But basically, resilience is getting harder and harder. You have more pieces of technology, you have more parts of your infrastructure scattered all over, whether it's people working from home, data centers, branches, whatever. And there are so many different pressures on that. Now, it could be something fairly straightforward like ransomware attacks, which happen all the time. And there are some very straightforward things you can do from a cyber perspective to deal with that. But it could also be the resilience of your ATM networks or the resilience of where your branches are. And are there downstream effects that might not seem like a big deal, but might still impact it? An example I'd give is there was a data center in Texas earlier this year that had an outage. The cause of that outage was basically because a generator failed. But the reason the generator was even on was because of an electrical issue. And because Texas isn't connected to the rest of the grid, Texas was having electrical issues. And this one data center went on. And a very surprisingly large number, I'll say it like that, of institutions had degraded service because of that. But the sequence of things from electrical issues in Texas to a generator that hadn't quite been maintained the right way to a server going down, and that server, nobody had quite put all the pieces together to realize that one server was a single point of failure. You end up in a situation where the resilience of many institutions was compromised fundamentally because somebody didn't change the oil in a diesel generator, right? That is the kind of thing we're talking about. And those kind of unintended impacts, those things where you might be sitting there in your C-suite and your board, and you might not realize that you have a dependency like that, but it could still hit you pretty badly. Now, in this case, it wasn't that bad. It was a degraded service. It was manageable. People could get through it. But what happens, 5 years from now when the level of federation, level of decentralization of some of these systems are operating, you can have these issues. And in some cases, you might not even realize it. And so that's what resilience is about. And at the end of the day, we have to have a system that works 367, 24/7, and that any customer can do whatever they need to do whenever they want because that's what the customer demands. By the same token, we have to make sure that these systems are secured, that they're managed the right way, that the security around them is mature, that they're audited the right way. And that is the resilience discussion. Amplification. So it's really funny. I was on amplification. I was actually I didn't know what to call this. I knew how to explain it, but I didn't know the right word. And I was talking to my partner, and she used to be a federal prosecutor, and she was just like listening to me. She's got the best vocabulary, and so she picked amplification. So I get to give her credit for calling this one amplification. But think about it like this: every single one of you is an expert. Every single person who reports to you is an expert. Your board, your C-suite, the direct reports, the service providers. You guys all know what you're doing better than almost anybody else in the world. How much of your time in a daily basis is spent actually being an expert versus doing something else, whether it's email or typing away at some Web 1.0 system to run a report or whatever? You are de-amplified as a human being. And, you look inside the regulatory community, you look in the banking, you look anywhere, and you see inefficiency, you see friction. But you see people who you're paying to be experts, who are spending a lot of time on things that aren't related to their expertise or the value that that expertise creates for your organization. This is a massive challenge. And as we move to bring in AI and some of these more automated technologies, this will be a way to solve this. I will give you a fantastic example of amplification. There are a lot of organizations out there where when your staff goes home at night, their phone is not the fully featured piece of technology that allows them to interface in any way whatsoever to get their job done. And every organization could probably do a better job of that, whether it's not just being able to do emails and phone calls and text and chats or all that stuff, but also I have to sign a lot of documents because I work for federal government. There's lots of traceability and lots of process to follow. Can I sign everything I need to sign from my phone, or do I need to go and turn on a computer and that kind of stuff? There's a huge set of work there that we could all do much better on. And then finally, protecting the future. This is a little bit of the catch-all. The biggest thing for me is, if you go back in time 5 years, we knew ransomware attacks were going to become a thing. We knew even back then that multi-factor authentication was a good thing to have. We knew that artificial intelligence was coming. And for the most part, the regulatory community was not as proactive as they could have been to prepare for these kinds of things, so that they could get ready for it, but also create a true north for people to follow. And that, to me, is what protecting the future is about. And we talk about artificial intelligence quite a bit. We talk about cybersecurity. We talk about quantum computers. We talk about I joked when I first took this job that at some point somebody like Elon Musk is going to try to put a bank on Mars. And after a month or two, I got a news alert that 2 different companies are talking about putting bank servers that actually run banking technology in orbit. And then I found out about a week later that on one of those same missions, a crypto company is putting a crypto node in orbit. And so I'm like, okay, great. My joke about 20 years off in the future is already happening. So I need to come up with something, more likely to happen that's a little crazy 20 years off. So I'm still looking for that. So if anybody has any other ideas, let me know. And so what does that mean? And what have we done around that? So, on protecting the future, I think some of you would have seen there was a multi-agency RFI on artificial intelligence that came out. We did the same thing with digital assets. And don't be surprised if you hear more about quantum from my office here in the very near future. But fundamentally, I want us to get more proactive, and I want us to be more transparent about it. Quantum, and the way I would say it is, I don't think there's a single person that can listen to this out of my voice who is worried about quantum computers being used to hack your banking system. It's not really a thing today. There aren't a lot of operational quantum computers out there that aren't either owned by our government or a couple of large tech companies. However, imagine a bad guy at some point gets access to a quantum computer, and it is designed in such a way that it can break all of the encryption that you use on a daily basis in real time. That is something that could very likely happen in the next few years. And so we have to get ready for that. We have to start doing things about it. And so NIST, the National Institute of Standards and Technologies, has started a couple of years ago, started a program to build what's called quantum resilient encryption. And so it's basically going to be a new version of a lot of the same encryption that we use on a daily basis. It's called RSA. And out of that, in 2023 or 2024, something like that, they will come out with a standard for what that technology should look like, just like they've always done. NIST is a real crown jewel of our government. It provides so much value across the planet. It's absolutely fantastic. And out of that, companies will build technologies that are quantum resilient. And they're already working on it, but that's when the standards come out, and that's where people go down that path. The math that you have to use to encrypt RSA, let's call it a 1 out of 10 in terms of the amount of computational effort. Quantum resiliency, it's like a 7 out of 10, maybe an 8 out of 10, depending on how it goes. Well, I guarantee you most of the servers that run most of the important transaction systems in the banking system are not fast enough to do that. And so all those servers have to be replaced. And if you haven't replaced a server in 5 years, 10 years, 15 years, that's going to be a bit of work. And so I hope that we can get to a point where we can start laying out a roadmap that says, listen, we know this is coming X years in the future. And here are the steps that we all need to take together so that we can make sure to make that transition happen in a thoughtful way. So that's an example of the kinds of things I want to do with protecting the future. So with that, I believe there is another polling question we'll jump to.
All right. So our third polling question is, what is amplification in the context of FDI tech? A, remove barriers and reduce repetitive activities. B, increase the technology budget. C, maximize the human capital through the power of technology. Or D, both A and C.
And Sultan, while people respond to this, I wanted to interject a question. And we kind of talked about this in the workup to the presentation, that when we think of FDIC, current seconds, kind of that regulatory role, and that's how the strategic plan goes. I know, the chairman spent 2.5 years finding you, and so I suspect some of it's timing in terms of strategic plans and the things that you're doing and the innovation. But can you comment on, is, for lack of a better term, I know you wouldn't accept the job if you couldn't affect change and do things, but is it going to be more integrated in the strategic plan going forward, and more than just kind of window dressing, I guess you could say?
Yeah, I of course would not call it that, but that's
right.
My view, right? The thing that's really great about the chairman, the current leadership team, and what we're all doing is these things are all getting woven in, and you don't rewrite the strategic plan of an organization in a week. And so what we're doing is using these pillars as ways to enhance every other piece that's in there. And so whether it's going down to personal goals, organizational goals, how we structure certain parts of the strategic planning initiatives, these are all kind of in-flight activities. Starting in February means I missed the last budget cycle. So there's a lot of budget stuff going on as well. So, this is not something where I can just, download a spreadsheet, change some numbers, and then upload it, and that becomes true. There is governance, go figure. So I think, that's the short answer to your question. I think there's a much longer answer that I would, that we could talk about, but let's start there. Okay, fantastic. Fantastic. I think that's great. A and C, that's exactly how I would answer it. And by the way, just if you do amplification correctly, you actually lower the budget, which I'm very excited about. So that's a great one to go. Excuse me. And I can't remember from a flow perspective, Gabe, if you wanted to throw in anything else here on this one, because I know you and I have talked about this just a little bit, or we can jump right into the next polling question.
Let's go ahead and do the next polling question, and we'll try to do some rapid fire questions at the end.
All right, so the last polling question is, what do you think should be your institution's highest priority on innovation? A, inclusion, B, resilience, C, amplification, or D, protecting the future? And then also, while you're answering, if you would like a copy of today's slides, you can download them from the folder that says slide deck and handout. And we'll also be sending them out via email tomorrow, along with a recording of today's webcast. We'll leave this up another 5 seconds or so everyone can get their CPE. And once you have completed your CPE requirements, you can download a PDF of your certificate right in your console in the CPE progress window. All right, here are the results.
Well, you have no idea how much that makes me happy to see protecting the future come out so strongly there. It's obviously the one I think is the big one. You know, we spend so much of our time talking about the inclusion side and the resilience side that you know, I worry that one gets lost. But I'm incredibly encouraged to hear the almost 500 people vote that one the highest. That's fantastic. Okay, so let's go from me speaking hand wavy hypothetically to talking about a couple of concrete things, and I am very focused on a number of different activities that we should be doing, and can talk about those in a little more detail, including our another next tech sprint and stuff like that. But here's for you guys, you know, and I like putting these three things together because it's the same advice I give a lot of different organizations, but this is a big piece of it. And so the first is, you know, I started this conversation by talking about data. And I would come back to that. You guys have some of the best data out there. You can do a million things with that data. You can find bad guys' behavior. You can manage your risk effectively. Great. That's one side of it. But then there's the other side of using it to grow your business, using it to understand how you operate, you understand how to drive more efficiency, understand how to partner and how to use that data to express more value. And to me, that is job one. And I say that to FDIC, I say it to other regulatory bodies, I say it to trade associations, I say it to banks, I say it to credit unions. You guys have amazing data, and that's the biggest challenge. A number of years ago, I wrote a paper that talked about one of the limiting factors of growth of artificial intelligence was the lack of data. And this is one of the few areas where the data is there, it's just got to be organized and utilized the right way. Every single person listening to the sound of my voice has access to data that others would probably kill for because of the value that can be extracted from that data. And so you got it, you have the freedom to use it, you should use it. The second one on the resilience side is, and this is something, the piece of advice I give every institution, who on your board of directors is accountable in a RACI model for resilience for the organization. Every board of directors should have someone like this. This is an absolutely critical component. And it doesn't matter what model you use underneath that in terms of how that's managed relative to the C-suite and the operating model of the organization, but it absolutely needs to be there and needs to be at the board level. If you're not quite sure where to start, I'm a scholar at the Carnegie Endowment, and about a year and a half ago, we put out basically a package of content and basic ideas around what boards of private financial services companies should be doing in this regard. And it's called the FinCyber Toolkit, FINCYBER Toolkit. Very readable. You do not have to be a domain expert. It's designed to be read by board members. And I would highly recommend people grab that, take a look at it. There's some great content in there. There's some great first steps. It's generic enough that it should fit almost any financial services organization out there. The third is technology is not optional. I am not saying, and I will never say that technology will never replace a great banker sitting across the table talking to somebody. That will always be there. That will always be part of it. But the technology is no longer optional. You can't just be good at branch banking. You can't just be good at the in-person banking. You have to be good at technology. And it can express itself in a couple of different ways. It can be, you have to fit the amount you spend on technology relative to the value it creates into your balance sheet the right way. That's being good at technology. You need to be able to offer very compelling and interesting products and services through digital channels that completely augment and replace the traditional branch activity. That's being good at technology. You maybe can have a higher efficiency ratio because you've automated a lot of what you do that you maybe didn't have automated 10, 20, 30 years ago. But that technology, it's a core piece of your operating model. And I really think that I can say that comfortably for a regulatory body. I can say that comfortably for a tech company, for a bank, and everything in between. This is, in 1985, you didn't hire people who could build automated workflows, but also perhaps be an accountant. Now you are. And adding that technical muscle to your hiring process, adding that technical muscle to your operating model, those aren't optional anymore. Because at some point, you're going to discover that if you were to look at your biggest competitor and your balance sheets, and you were to just look at him, you'd say, wait a minute, he's spending 1/10 what I am on technology, or 1/3 of what I am on people. And it's because they figured out how to maximize the utilization of technology. These three are three great starting points. You don't have to do all three, but I'm sure one of these three resonates with almost every single person sitting here. And that becomes a step in the right direction. The regulatory system, there are a lot of different philosophies about regulatory guidance. Some people have a very prescriptive model. Some people have more of a true north model. Some people have more of a hands-off model. And because of the way it works here in the United States, you kind of get a little bit of everything. But the fact is if you're moving the needle on any one of these three things, it's going to make your interactions with the regulatory system easier. It's going to make your discussions with people who work in other offices down the hall from mine easier, right? I'm not an examiner. Don't ever call me if you need help on an exam. I'm not your guy. But if you're working with your examination team and you're doing something on one of these three, all this is moving the needle on one of these three is just going to make it better. All right. So with that, I will just go to this last page because I believe it does have, yes, my favorite email address, innovation@fdic.gov. For all of you, please do not hesitate to reach out. We're more than happy to be of service to all of you. And I'll brag on a community banker I know to close this out. I got the idea for doing this email, because a very good friend of mine, Lee Keith, who used to be banking commissioner of the state of Missouri and was a 30-year banker before that, he got a little bit known as the guy when the bank was failing, you come in and he fixes it. And he's just one of the most wonderful people out there. And when I first met him, he had figured out how to get the Department of Finance office in Missouri to go from having an average return of something like 6 weeks from when somebody asked them a question to when they got an answer to something like a day and a half. And it's because you could just call him, you could just email him, you could just call or email the staff. And that's what we're trying to do with this, is we really want people, not to wait 90 days to have to get an answer for something. And so please do use innovation@fdic.gov. I'm more than happy to have the team answer that or reach out to us and figure out what we can do next. So with that, Gabe, I'll stop the official part and we can get into the Q&A.
Yes, we've got a number of questions around fintech, which you're very well positioned to provide some insight there, and I'll try to meld them together. But essentially, oversight-wise, and what the fintechs are doing, the partnership with the bank, and how do you see, regulatory-wise, that oversight piece? Is it going to push through to the fintechs? Or I see some of the larger ones being fairly savvy and pushing all the compliance back to the bank, which the banks or credit unions, they, in the spirit of moving things forward, seem to take at this point. Maybe they wouldn't later, but obviously there's a lot going on in the fintech space. You referenced the numbers. There's the paper that came out in the partnership. So how do you see that oversight piece possibly going? I know your group's looking to be more proactive than reactive. We've also got questions on anything that scares you that you've seen out there, or any setups or agreements that are very problematic on the surface, anything like that. So lots of different questions within there, but I'll let you have at it.
Wow. I mean, that's only like a 2-hour answer with footnotes and, a couple of white papers. Well, I will say, last year we put out an RFI on standard setting. And back in the dawn of the internet, we put a bunch of standards together so that people could interoperate and we could figure out how to drive some efficiency into the system. And there's an idea that we might be able to do the same thing here, and maybe not set standards for everything, but we got some amazing responses, and we're kind of working through what that's going to look like. But I would love it if we could find ways to create standards that would decrease the amount of repetitive effort. So, for example, you've got a mid or a small size community bank or credit union. Wouldn't it be great if they're working with a third party and they don't have to do any extra examination because they've already gone through an exam? That tech company has already gone through an exam, and they have maybe not a full-on seal of approval, but they've gone through a process that alleviates some of that. So first off, you don't need to duplicate the same thing 250 times to get a different result. That is the definition of insanity. So that's one thing we're looking at right now. I think you've seen a couple of things come out about third-party risk management from the different agencies. So obviously this is a high topic for us. Statutory authorities that a lot of us are operating inside of predate a lot of these discussions, right? And it's going to be a big challenge, I think, for a lot of us as we work through this. But we are, kind of grabbing it by both hands. The model in the market has changed. 20 years ago, if you had tech, you signed one, crazy long-term contract with crazy termination fees, and you had all this extra expense and everything for fundamentally a very lightweight database. And, nowadays, you don't have one contract. You might have 10, you might have 15, and you have little different pieces that all interoperate together. And so the burden then on the institution actually goes up because they have to navigate all of it, to manage the contracts, manage the interoperability, the interactivity. These are all hugely time-consuming activities. And so, as we continue to go down this path, we're going to have to think through ways to make it easier, because think about it from our perspective. We have thousands of institutions we examine, and I see duplicative effort across the board, and I see a lot of kind of hand by hand one-offs across this, and it makes it incredibly challenging for us. We can't hire fast enough. We are, if anybody here wants a job, I got a couple hundred open right now. So, anybody who's willing to help us there can help us. But fintechs are part of the ecosystem. It's part of the discussion now. The thing for me is about how we do it in a safe and sound manner, and how we ensure that there's a reasonable amount of efficiency brought into this entire system, so we don't end up just going crazy with one-off exams for every fintech times every number of banks. That's just that to me is not the right solution.
Thanks for that. And you're right, that's a couple more hours webcast. Another question, hopefully we get to the rapid phase prototyping. Several questions around innovation and the call reports, and I saw the 4 companies were picked. It was Novantis, S&P Global, Palantir, and PureIQ, and they're doing papers, and I know they're doing something around the call reports, the utilization of that data. And is there anything you can comment on there, and maybe timeline, and what exactly they're trying to help out do?
Yeah, sadly, I can't talk about too much beyond what you just said, and you did a wonderful summary. Out of the, we started off with over 30 last year. We got to, I think it was 11 this spring, and we've gone into this pilot phase with 4 groups, or potentially 4 groups, and we're kind of working through that process right now. The fact is we have thousands of institutions that all do everything subtly differently. And so finding ways to build commonality across those is a big thing. But our goal is to create as much efficiency here as we possibly can, simply by fixing some of the process issues, and making the technology work better together. And it should be telling the kinds of companies we picked, because these are really great high quality technology firms.
All right, we got a number of other questions, but we are out of time and need to do the logistical wrap up here. So I'll kick it back to Amy.
All right, thank you, Gabe, and thank you, Sultan, for a great presentation today. Yeah, unfortunately, we are out of time, but I do want to thank the audience for being engaged and submitting your questions to help guide today's conversation. And as always, we have several resources available for you on our website. Some of them already linked for you in the console, including a link to this webcast series. We still have 2 sessions left, an economic update on September 30th and a cyber risk topic on October 6th. And also, if you met all CPE requirements, your certificate is available to download now in the CPE progress window. I will keep the console open for a few minutes to give you time to download, and a copy will be emailed within 3 weeks should you have difficulty downloading it now. And here is a link to an online survey for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. And thank you for joining our webcast. We hope you'll join us again next time.